quite small in population and GDP, we cannot cover throughout 225 years. So simply what we do, we group them in other regions, other Latin America, other Europe, and so on, because we do observe them across time, but not consistently. So to construct the database, it allows us to construct consistent global series on world trade imbalances, current account surplus and deficits, and net foreign wealth over these 2 centuries. And we can find things like this. This is the net foreign asset positions of regions across time, and this is the result of the cumulative current account. I will explain this a bit in a second. What is important in this graph, which is one of the main graphs of the papers, is to see how Europe accumulates foreign wealth across the 19th century at the expense of the rest of the world, which are all indebted. So basically, because Europe receives more money from the rest of the world than what they send to the rest of the world, they accumulate foreign wealth, which accounts at 60% of their GDP in their peak in 1880, 1914. They quickly lose their foreign wealth in between the wars. They basically spend it all fighting each other, and they get indebted and so on. We see the North America, Oceania, which is mainly the US region, rising in between the wars and becoming the hegemon, but quickly falls after the 70s, and is in a position where today is quite indebted, and this is what actually is creating all the Trump obsession with trade deficits and so on. And we see since the 80s, 70s, the rise of East Asia, which is the red line, which is mostly Japan and China, based on the export of manufacturing, and also the rise of the Middle East and North African line, the orange one, which is mostly accounted for the export of fuels. So the main objective of the paper is to compare the current imbalances, the one that Trump and China are fighting right now, with the historical period, specifically, particularly in 1914, before the First War, where we saw that the large imbalance of Europe. The main difference that we find is that the 1914 imbalance was bigger as a share of world GDP, so in total economic size, I will show you in a bit, it was of a larger magnitude, and it came to happen because of the key role of colonial transfers and low commodity prices, which are related to forced labor and slavery used in the colonies, which allowed Europe to build up the foreign wealth. Actually, Europe, and something we didn't know, they were never in a trade surplus throughout the 19th century. Still, they managed to amass large foreign wealth positions, and this is kind of against all the development strategies that we think today, where they ask developing countries to export more, to build foreign wealth and foreign reserves. Actually, Europe never did it in history. They simply took from the colonies. Today, another difference is that we have a declining hegemon, which is the US, with a large amount of foreign debt, and a rising hegemon, which is China, amassing also an amazing amount of foreign wealth. The similarity between today and the past is basically that we think there are low commodity prices that play a critical role for wealth accumulation by the manufacturing power in the past Europe and today East Asia. And we will argue throughout the whole paper that small changes in bargaining power and terms of exchange could have completely reversed the relative positions between the North and the South. In a more theoretical way, what we try to answer is if global economic relations are characterized by self-correcting market mechanisms, or if there are always power imbalances and power relations that play a role. Of course, our answer would be that there are persistent imbalances and power relations that have played a critical role throughout these 2 centuries, and that leaving things to self-correction can end badly. And we think this is a good moment to actually think international economic relations more like a collective process. We know that they can be mutually beneficial for everyone taking part in it, but maybe to reach their whole potential, we need some of collective rules. And we can think about historical proposals like Keynes in the International Clearing Union, which was, for, in a nutshell, Keynes, what he did, he proposed in the moment of Bretton Woods, which is when the World Bank and the IMF are created. He proposed a third institution, which was basically to deal with current account deficit and surplus and to try to correct them and not allow any country to have lots of debt, and also not allow any country to have lots of foreign wealth, and also to impose a common currency to avoid the dollar being so central. And this didn't pass because basically the US had the upper hand. They said, no, actually we're happy with the dollar being the central and so on. We will do what we want. And they went with the IMF and the World Bank. We think this is a good moment to kind of revive this type of collective ideas. Okay, so if I have time, this is what we will talk about today. Basically, I will walk you through quickly how we build the database, which was a huge amount of work. Then I will show you what global trade and balance of payment flows look like for the 2 centuries. Then which countries accumulate current account surpluses at deficit and their foreign wealth accumulation, how they manage to get this surplus and deficit, and then some exercises where we try to imagine a world where colonialism didn't happen, more or less, and what this would have been. Okay, a bit of the most boring slides. What we do to construct the database, basically we start from IMF balance of payment series, which are quite complete from 1970 to today. And we define the current, we take the current account there and we group the subaggregates in 4 more or less broad categories, where we have net trade balance in goods, so all of the goods that exit or leave or enter the country. Net trade balance in services, so services could be consulting, IT, someone working for a company in the US from France, etc. But also can be shipping of goods. So typically in the past, or even today, if you want to send a good from France to Argentina, you might use a third-party ship, and this is a service export from the country that belongs this ship to. Income flows. Income flows are mostly capital income, but they can be also labor income. So income flows is basically the result of the factor of production retribution in another country. So if you are French and have an investment in the US, and then the money comes back to France, that's a positive income flow for France and a negative income flow for the US. The same if you hold Argentinian debt and Argentina pays you the interest rate. That's an income flow for the income inflow for the one that receives the interest payment, as an income outflow for the country that pays it. And net transfer inflow, and this is very important. So net transfer inflows are flows, monetary flows that don't have a counterpart, so you're not buying or selling any services. You are simply giving like a gift, let's say, which could be remittances today, so migrants in the global north that send money back to their families in the global south simply because they want to. Public aid, also very nice. Governments in the global north give money to governments in the global south to aid them with development. In the past was more war tributes or colonial transfers or imposition from imperial powers to the colonies saying, okay, you need to pay me X amount of money just because. And this is super important because it's a key part of our results. Okay, then we complement this for the rest of the period with historical trade data in goods. Data in goods is very well covered. Actually, there were lots of economic historians that study trade in goods, and we simply kind of rely on their research. They have done an amazing amount of work, especially the Federico Tena database, basically because trading goods, you always saw them passing a border, and when you saw them, they typically had, they charged tariffs on them. So if you charge tariffs, you have an incentive to record it. So it was recorded somewhere in the public registries. Let me skip this. And then we complement the rest of the balance of payment with the invisible flows. They call invisible basically because you don't see so much the money passing by, but you have to kind of estimate it, which are, as I said before, services, income, and transfers. For this, we use official sources of the League of Nations. So the League of Nations, I guess everyone knows here, is the institution that was before the United Nations, that between the First War and the Second World War kind of tried to ensure that there was peace in the world. It failed, but they did a good amount of statistical work and very valuable. So we write in their official estimates of the balance of payments. We also have some IMF historical records, but a bit incomplete. And luckily, there are lots of country studies that have studied countries' balance of payment historically, typically for the economic historians of a country have done it because they liked it, like Imla did for the UK, Douglas North for the US, Lévy-Leboyer from France, and so on and so forth. We have for Argentina, Brazil, India, Indonesia, China, Russia, etc., etc. So we gathered all of this, we put it together, we compile it, we harmonize it, and so on, and we build the rest of the database. So that being said, we don't have every country for every year, so we do some typical assumptions, like if we don't have France from 1855 to 1860, you assume that it follows the same trend as it was from 1850 to 1870, more or less. We do a consistency check where we cumulate the current account. So this is very important. The foreign wealth estimates that I will show you is basically this result of the current account. So the result of all the transactions that you do with the world should result on if you have foreign wealth or foreign debt, because if you have a positive result of the foreign transactions, you can invest this somewhere, and if you have a negative, you need the money to pay for this, so you will have foreign debt. So we don't really know what was your foreign investment or your foreign debt. We know that it should be this level because of the result of trade, income, services, and so on. There are some studies that have done stock estimates of foreign wealth or foreign assets for countries. We compare with them our estimates, and it makes more, and they match, so we're quite happy with what we get. And typical studies are Giffen, Faubil, even Lenin for the assets in Russia, and so on. So when we do this consistency check, everything works more or less well, so we're happy. That being said, our database, which is also already available, you can access through it online and you can play with it. Our series are not frozen in stone. If we find some better country-specific studies, we're happy to incorporate them. Okay, and finally, of course, our work is closely in spirit to the classic works of Unequal exchange, for instance, Prebic, Frank, Emmanuel, Amin, Cardoso Faleto, more recent work by Karen Furo, Jason Hickel and his team, Magalhães et al. Are also close in spirit to what we do. Our contribution is more to offer a long-run quantitative global perspective on trade and financial flows, which leads us to stress the transformation, but also the persistence of Unequal exchange over the past 2 centuries. Okay, now it's starting with the funnier part. So this is how global trade flows looked in between 1800 to 2025. This is as a share of world GDP, so relative to the size of the economy of the world. We see that global trade increased until the First War, decreased sharply until the 1960s, 1970, then rises again, and especially since the 1990s. And then since 2008, more or less, it kind of plateau, and it reached a point where economists are starting to talk about slowbilization because it's not growing, not decreasing. But also its magnitude has also changed. At the beginning of the period, commodities, which is the yellow area, was the most important traded good, being 3% of the world GDP, then came to be 8%, and then it decreased until being 7% of the world GDP today. Manufacturing and services, manufacturing being the red one, services the blue one, were less important than commodities. They were 2% of the world GDP. Manufacturing rises a lot right before the war, it reaches 5% of the world GDP, then stays constant, and today is more or less 16% of the world GDP, which coincides with the global value chain revolution. So like many things that are being traded as intermediate outputs today in the world. But services remains more or less constant until the 1970s, and then rises quite significantly, being 7% of the world GDP today, being the same as commodities. And this is basically, of course, based on the trading services of consulting and this IT kind of trade that we see today thanks to the IT revolution. If we include the other aspects of the balance of payments, so in green, we have income flows, which is mostly capital income, and in purple we have transfers. We see that income flows were more or less constant, also 1.5% of the world GDP across the period, until the 90s, where capital started traveling cross-border a lot. There are many capital in tax havens and so on. And then, of course, if you have more capital abroad of your country, we will also have more capital income because it has to come back the income that capital generates. And transfers has remained more or less constant throughout the period from being 1.5% of the world GDP. What is important is that until the First War, the bulk of transfers are colonial transfers, and then afterwards it's mostly public aid and remittances. So it really changed from being south to north transfers to being north to south nowadays. Okay, let me show you how these countries accumulate current account surpluses or deficit and how this results in foreign wealth accumulation. As I said before, in the first century, Europe accumulates large current account surpluses and foreign wealth holdings, despite not accumulating trade surpluses. And a bit similar to what East Asia and oil countries do today, but in a different way. So this is the result of the current account decennial averages per region. Of course, since we saw that Europe had like a positive position, it's natural that their current account is always in a positive sign throughout the century. The rest of the world in the first century record always deficit, except for the US a bit in the 1840s. But then really, starting with the wars, Europe starts recording current account deficits, or starts importing more than what it exports, or buying from the world more than what it sells. The US rises as a hegemon with current account surpluses, but quickly in the 70s, when the Bretton Woods system falls, the US starts recording current account deficits, and actually quite large in magnitude. And then the Middle East countries, after the creation of OPEC and the nationalization of oil firms in their region, they start recording current account surpluses, together with East Asia, thanks to the export manufacturing, and Russia, which is the darker orange line, thanks to the export of fuels also. If we separate, so this is the same graph as before, but now in the European line, I'm only leaving European imperial powers. It's only France, UK, Germany and the Netherlands, and the rest of the Europe, like North Europe, the Nordic countries, South Europe, etc., are in this light green line. So if we separate Imperial Europe from the rest of Europe, we see that actually the line shift upwards. So they are very, like the concentration of foreign wealth of current account surpluses happens really in the main imperial powers in a handful of countries, where the rest of Europe behaves as the rest of the world. So basically there's a lot of intra-European inequality as well. It's not the same being in France that in Spain at that time. Spain is a curious case because Spain kind of, we would have expected Spain to have like a positive foreign wealth, but actually they lose the colonies at the beginning of the period. So actually they don't manage, in the time period that we measure, we don't see like a rising power in Spain, actually a declining one. And this is simply to show you that economic benefits are concentrated in these imperial powers, basically, and it's not the whole European continent that is getting benefited. If we put this as a share of the world GDP instead of a share of regional GDP, so this is everything is relative to the size of the economy of the region, which is relevant to see. But if you want to compare regions between each other, you put everything relative as a size of the world economy. You see that the European line today, of course, this is smaller in magnitude because the GDP of the world is bigger than the GDP of Europe. But the European line is quite high compared to the rest, especially if we compare it to the current account surpluses of East Asia today. They're not even near. So today, East Asia, China especially, each year records more or less 0.5% of their GDP, of the world GDP as current account surplus, which is impressive, and every country would like to do that. But it's comparable only to Europe, like beginning of the period Europe, not to peak Europe, where peak Europe they were recording 1.5% of the world GDP as surpluses. What is very astonishing is the deficit that the US is recording, which are more or less 1% of the world GDP each year, and also it's unprecedented in history. So this is like why we think the US is so stressed about the accumulating foreign debt, because we don't know what could happen actually with so much debt. And this is the same figure, but as yearly. So these were decennial averages. This is the year, simply the yearly measure, just to show you that first it looks much more awful because there are many things that happen year to year, so it's really bumpy. But what is important is actually that each and every single year, Europe was in a positive current account surplus throughout the 19th century, where the rest of regions, sometimes they recorded the surplus, most of the time they recorded deficit, but they kind of are always jumping up and down the zero line, but Europe not. The whole time they were recording a trade surplus. I'm sorry, a current account surplus. This is the figure I showed you before, so I will skip it quickly. This is the same figure, but separating again imperial core Europe from the rest of Europe. Of course, the line shifts upwards, and then you can see that actually they managed to amass 120% of their GDP in foreign wealth in their peak in 1880, 1914, which is incredible, and it's unrepeated in history. And let me show you some important countries. So we have the UK, France, Germany, which are the three of the four imperial powers I showed you before. Of course, they record positive foreign wealth, different magnitudes. As a share of their own country GDP, the UK is the biggest one, but also the UK at that time had the biggest economy in the world, so it's also in absolute values the biggest foreign wealth in the world. France is quite close as a share of their economy. Germany is a bit more shy, and it rises in the 1860s. In the 1880s, Japan starts rising a lot, but then loses everything after the Second War, to then rebuild it after the 70s with the industrialization process. The US is more or less on the zero line, manages to get this positive, as we discussed before, the positive foreign wealth in between the wars, replacing Europe. But then after the 70s, quickly becomes indebted. And then we have countries like India, which are always indebted. And if you see some Latin American countries, you will see that also they're always indebted. If this is a bit quickly, as I show you things as a share of their country GDP, we could add smaller countries that have large foreign holdings, like the Netherlands, which had lots of holdings in their colonies in Indonesia. It's huge as a share of their GDP, but their GDP is way smaller than the UK one, so actually in absolute values, it's not comparable to the UK, but because they are such a small country with such a big holding in Indonesia, for their economy is super important. The same as the case of Norway today with the oil, sovereign oil fund that you have. Actually, Norway economy is not so big, but actually they have so much holdings in the sovereign fund that is quite important. It's 3 times their economy, and similar with Saudi Arabia, for instance. And this is simply foreign wealth as a share of the world GDP, again, to have everything relative to the world economy size, to see the striking difference between imperial peak Europe with the rest of the world today. Imperial peak Europe had 40% of the world GDP as foreign wealth. China today, again, has only 10, when I say only 10% is huge, but it's nothing compared to imperial peak Europe. If anything, it's compared to 1820 Europe. And as I mentioned before, the huge US foreign debt, almost 20% of the world GDP, it's unmatched in history, and we don't know if it's sustainable. And here it's quite clear why the whole US-China fight is happening today. Okay, one clarification. Since here we have these imperial powers that are always in a positive position, so they always have always have positive foreign wealth, and the rest of the world is indebted. We don't know where these Europeans have their investments, but we can, based on this, calculate the average European portfolio. So it has to be that if these regions are net indebted and this region is net creditor, the portfolio has to end here. So we can calculate the average European foreign wealth portfolio, and we see that there is a huge presence of the colonies at the beginning of the period, especially in South and Southeast Asia, which is basically UK holdings in India or Netherlands, Dutch holdings in Indonesia. Then North America rises after the 1860s and reaches 27% of their GDP, or the GDP of the imperial power. Sorry. Then let's see how the Europeans managed to build wealth today. No, sorry, in the past, and how the East Asian countries managed to build wealth today. So this is the net trade balance in primary commodities, so agricultural fuels across time. Uh, we see that the European line is super deficitary, so it's very, very below the zero line. We all know the story of during the Industrial Revolution, Europe importing more commodities to produce more and then export manufacturing goods and so on, and that's what industrialized and they managed to like progress and so on and so forth. The rest of the world were providing these commodities. The East Asian countries have experienced a negative result of trading commodities as well since the 1940s. Today, the situation is similar again to the beginning of the European buildup of wealth. But as I said before, Europe was exporting more manufacturing goods than what was importing, thanks to these commodities, basically, thanks to the Industrial Revolution and the import of commodities and so on, which accounted to at the peak 2.5% of the world GDP, more or less, similar to what China and Japan are doing these days, although it's a bit high. I mean, China and Japan are quite close to European peak moment, and the US is recording big deficit in trading manufacturing goods, actually minus 1% of the, minus 0.5% of the world GDP. If we combine these both lines, so trading goods, so trading commodities plus trading manufacturing, we will see that actually Europe, even though Europe was industrializing and selling more manufacturing than to the rest of the world and importing to actually produce, the result was negative, and it was negative throughout the whole period. So if we just see this picture, which is actually what many economists do, they simply check the trade balance, you would expect Europe to build foreign debt because every year they were importing more than they were exporting, so where did the money come from? It has to be that they get indebted to pay for this. I showed you before actually that they get foreign wealth, so I will show you in a bit. So we were very puzzled for this because we, like kind of in the economic literature, you know that Europe built up foreign wealth across the 19th century. We thought it was coming from there. Actually, it's not, so we were very puzzled, and that's when we started looking around. Important in this graph, there is actually for China today, the export of manufacturing is enough to revert the negative position of the import of commodities, unlike Europe in the past. And again, of course, we all know the super trade deficit of the US. So where is its European wealth coming from in the 19th century? A bit comes from the trading services, which they have like the only region that has a positive result in trading deficit, and this is basically because the UK and the Netherlands are kind of dealing with all the transport of commodities or manufacturing goods in the world. So import or exports of goods pass through ships that are owned by UK or Netherlands, and that's a lot of money around the time. But it's not enough. If we combine the previous line with trading services also, it's still below zero. So still, they will have had to accumulate foreign debt. So where is the wealth coming from? Part of it is coming from net foreign income. So they get more capital income from the world from what they pay to the rest of the world. And it's quite significant. It reaches 1.5% of the world GDP in their peak. However, this is not enough to actually counterbalance the trading deficit, the deficit in trade. It's only enough at their peak in 1880, 1914. It would have resulted in a positive current account and then the buildup of foreign wealth. Before that, it's nice, it would have helped and so on, but it's not enough. And I will show you then you can tell me where do they get their foreign wealth from. What was important here is also that actually this rises a lot, but rises mechanically. And if you see that the shape is very similar to the foreign wealth graph I showed you before, basically if you have more foreign assets than foreign debt, you're more likely to get income from the rest of the world that is indebted to you than what you pay. So if you have more, you keep receiving more interest payments from the rest of the world, and this is simply mechanics. So where is there foreign wealth coming from? Where this is mostly thanks to colonial transfers. So this is kind of small as a share of world GDP, but actually quite significant still. But it plays a key role at the beginning of the period because it allows Europe to record current account surpluses at the beginning of the period, and with that accumulate foreign wealth, and with that keep accumulating foreign wealth until a point where foreign capital income is so important that colonial transfers, they don't care about it so much because the investment abroad are so profitable that they can pay their debt with that. And this It's mostly day-to-day charges that the imperial powers impose on the colonies. So, for instance, the UK would charge taxes to India and ship them back. The same with Netherlands with Indonesia. Typically, the UK, if you check the bilateral relation they had with India, they will have a trade deficit. So they were importing more Indian goods than what they were exporting to India. And the way to pay for this deficit is basically tax the land and use this money to pay for their exports. So we'll tax the households and they will tell you, okay, thanks for what you're selling to us, this is your money back. So it's a form of appropriation, and this is how they manage to accumulate this yearly. Then we have other episodes which are like particular, like for instance, when Haiti, which is in Latin America, achieves independence, the French charge them a huge debt. When the UK defeats China in the Opium War, they also charge them war tributes. China is in East Asia. When the Russian Revolution happens, the Russians say, okay, actually, foreign debt, I'm not going to pay about it. I'm not going to pay it. We don't acknowledge it. So it's a transfer from the holders of the foreign debt to the debtors. The Marshall Plan, when the US sends money to Europe to rebuild after the war, it's a transfer from the US to Europe. So these specific episodes play a role minorly. The most important is this whole colonial structure that was imposed in the 19th century. And as I said before, nowadays we see the US and Europe being in the negative side here because basically migrants from the global south send money back to their families. There is also part of public aid that plays a role here, but typically public aid nowadays is like 10 or 15% of global transfers, more like really 80-85% is remittances. So it's nice to have public aid, but it could be bigger actually. Okay, let me show you this. Let me maybe. Yeah, this is the same as I explained kind of before in a table to make things clear. So the way to read this is the net foreign asset position in 1800 as a share of the GDP of the Imperial Europe, UK, France, Germany, and the Dutch. And this is the net foreign asset position at the end of the period, 1914. So it was 3% at the beginning of the period. It ended up being 133% of their GDP. How was this 133% composed? So the 3% in terms of GDP at the end of the period, it's almost nothing because Europe grows so much that as a share of the GDP of 1914 is 0.0001%. They accumulate a deficit of trade in goods of 141% of their GDP, which comes mostly from primary commodities, 417% of the GDP. They have a positive result of manufactured goods of 276% of the GDP. This plus trade surplus in services is 61% of their GDP. Foreign income, which is mostly capital income, of almost 200, and transfers only being 22% of their GDP. So I just said actually that transfers are super important, but are really, really way smaller than the rest of the numbers. But the thing is that if we decompose this into periods, so this is 1800, 1840, 1840, 1818, 1914, we see that the role of transfers is super important at the beginning, but then it really fades out, whereas capital income increases with time, and basically because they have more, as I said before, is mechanically, if you have more foreign wealth than debt, you need rates of return being constant, you need to have more capital income than what you pay to the rest of the world. So what happens today? From same table, 1970 to 2025, let's quickly check Europe, North America, and China, and Oceania, and China. And let's actually check in North America and China, which is the most of the beef is there today. So 1970, the US, North America, has 1% of that GDP as positive foreign wealth, but ends the period, it's now minus 57% of the GDP. This is basically coming mostly from deficit in trading goods, especially manufacturing goods. They actually have a surplus in services. They have a surplus in foreign capital income, and they have a deficit in transfer because of remittances. Capital income needs a different subcategory. So from their capital income, which is 10% of their GDP, they accumulated 29% of their GDP as their excess yield. So the excess yield is basically the income that comes from the fact that they pay a very small interest rate in their debt with respect of their interest rate they receive on their assets. So the US has a huge debt, but the interest rate they pay on their debt is so small that even with being indebted, with the profit they make on their assets abroad, they manage to get a positive capital income, which is actually astonishing and doesn't happen anywhere in the world except for the US. So it's basically, to be clear, they get money kind of cheap from the rest of the world. They say, okay, we'll pay you 2, 3, 4, 5% of interest rate per year. With this money, they use it to invest in other countries, China, Brazil, whatever. They get 8, 9%, and this way they can manage to keep getting indebted, reinvesting, and getting more money from this investment than what they pay, even though their net position is negative, which is completely the opposite to, for instance, East Asia, where East Asia has a big amount of foreign wealth, being almost 50% of their GDP today, which comes off entirely from the surplus in trading goods, especially manufactured goods. They have a deficit in services. They have a positive capital income, but it's lower because of the excess yield. So the fact that they pay more rate of return on their debt than what they receive on their assets impedes them to actually accumulate more capital income, and they have a negative position in transfers as well. And this is just to show you the excess yield across time. So the excess yield will merit 30 more minutes, but I will do it quickly. The excess yield comes basically from the fact that currencies are dominant in the world, and since they're dominant, everyone wants to hold the debt of the country that issues this debt. So nowadays, the dollar is the most dominant currency, and then you have the euro. Everyone wants to have treasury bonds or euro bonds. Everyone wants to have treasury bonds. Everyone buys them, and this allows the US to issue them at a very low rate and then invest this money abroad and get more money. Similar to the euro, but to a lesser extent. And this is similar to what was happening in the past when the French franc and the British pound were the dominant currencies in the world, where the euro was also getting a positive excess yield of about 0.5% of the world GDP. And this I went very fast because I don't have much time, and we can discuss it later. Okay, so let me show you what could have happened with a different set of rules in trade or monetary regimes. So basically what we do that, now I will show you a set of simulations where we assume there are not colonial transfers, or we assume there is no forced labor or slavery. So commodity prices are paid taking into account the real cost. So we assume the commodity producers were paying the employees the fair wage, and this raise the cost, and this implies that they sell to a higher price. And I will show you what happens to the buildup of foreign wealth and what would have happened to development if we had this world. Let me just jump to the financial simulations. So basically, if we don't have colonial transfers, as I repeated before lots of times, then Europe would have built up foreign debt, and actually would have been keep increasing because they basically would have to pay for this foreign debt. And the region that would have been benefited the most would have been Southeast Asia, especially India and Indonesia, because they were paying the most of these colonial transfers. Then we would have a small benefit for Latin America. If we didn't have slavery, so if we increase the price of export of commodities, taking into account the labor that was embedded in it, again, Europe would be quite indebted because they reaching 60% of the world GDP, which is a lot, basically because they were producing a lot and using these commodities for export of manufacturing. And then the region that would have been benefited would have been Latin America, which was the region that was the most exporting commodities across this century. If we combine no slavery plus no colonialism, of course, then the European position is even worse. Then it reaches like 100% of the world GDP as debt, and Southeast Asia and Latin America would have been much better, and maybe Argentina will be better today. But we don't have this world, and we wouldn't, sadly. So for today, we don't have colonialism, luckily. So we cannot do an exercise without colonial transfers, but we could do an exercise where we think, okay, what if commodity producers do a kind of clustering as the OPEC countries have done, which I show you that really improve the terms of exchange for the Middle East and North African countries and allow them to accumulate foreign wealth. And they raise the commodity prices based on bargaining better with the rest of the world. What would happen? Well, of course, Sub-Saharan Africa and Latin America, which are the countries that export more commodities, would be better off. And East Asia would be a little worse off, still with a positive position, but worse off than what we see today. And the US and Europe will be in a worse off position. What could have happened to development? Well, let's assume that we didn't have colonialism, we didn't have slavery, and the gains that I just show you that these developing countries would have gotten were reinvested in human capital, education, health, and so on. So they will get a rate of return that impacts the GDP of the country. Which work could we have? Let's first, in case you didn't know, this is how real GDP per capita looks today in purchasing power, parity power, euros, whatever. So today we see that there is really a divergence between rich countries, the US and Europe, the rest of the world, and the gap with Sub-Saharan Africa is huge. What would have happened if we didn't steal money from the developing countries and we allowed them to invest in education, health, which maybe didn't happen, but let's assume that it would have happened? Well, the GDPs would have converged, GDP per capita would converge much better, increasing the world average, of course, and reaching a level of not complete convergence, but relative convergence. Evidently, everyone will be better off. Sub-Saharan Africa will be better off than today, but still not high enough to reach the rest of the world. So we argue that the only way that really to reach development policies in this kind of scenario would be to have a redistribution internationally where you send money to countries that are below like 70% of the world average of GDP per capita, and that would be the only way, in this case where we have a nice international institution that really works and redistribute money, that would be the only way to actually achieve a relative convergence of economic income throughout the world. And this is basically it. Let me conclude by saying that thanks to this new database on global trade flows and the world balance of payments over these 200 years, we are able to compare the different episodes of imbalances today with the past. We argue that power relations matter. Small changes in bargaining power and commodity prices can completely reverse relative wealth position of North versus South. Trade and monetary regimes play a critical role. We think that discussions about sustainable development today should include the structural transformation of the world trade and financial system. We think that without reforms of the IMF, World Bank, UN, OECD, etc., 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 it's impossible to achieve IPCC goals and this kind of development goals because rich countries are always in power there and they don't really suffer the consequences, so they don't have any incentive to push for a change. Okay, and future research, we plan to include other things like environmental perspective and so on and so forth. And that's it, thank you.